Avoid these 6 retirement planning mistakes. In this episode, we are going to address the question, why do so many people run out of money in retirement? So I'm Doug Andrew, and this is my radio studio. I've been very blessed to have a national radio show this is my 12th year. And also I've written 11 books. And so I wanted to share with you some of the key concepts that I've talked about on the radio, on TV, and in all of my books, how people miss out on fortunes because they simply don't know what they don't know. It was the title of my first book, in fact. And then my second best-selling book was called Missed Fortune 101. So let's get down to some of these reasons why people do not have the money they could have accumulated and they outlive their money in retirement. In an episode, I talk about an article that I wrote called 31 Flavors of Missed Fortune. 31 is the Baskin-Robbins number. So in this episode, I'm going to go through 6 mistakes that people make as it relates to retirement planning. They're choosing the wrong investments. And so I'll just go right down these bullet points and I'll read it to you and then I'll comment on it. So the very first one is using short-term investments for long-range goals and long-term investments for short-range goals. I have seen people do that for years where they put away money into a long-term investment. What would that be? Maybe a mutual fund. Usually a mutual fund, you should not use that investment for goals less than 5 years. Usually it's 5, 10 years or longer. And I've seen people put money in mutual funds and they treat it like it's a drive-up window at the bank. Like they sit there and they put and take the money. You don't do that, especially if the market goes down, people panic and they wait and then they sell low and then they wait till the market comes back and they buy high. This is one of the biggest mistakes people make, but the opposite is true. Many times they put money in the bank, earning less than 1%. That's a short-term investment. Maybe if you're saving for a baby for 9 months or to buy a grand piano for a year. But see, people put money in the bank and they leave it there for years. And I've come across so many people, I go, wow, you have $500,000 in the bank earning less than 1%. What's that earmarked for? Well, my retirement. Your retirement? How? That's 20 years out. What do you have it in the bank for? That is a huge mistake. They're missing out on a fortune. They're not even earning the inflation rate. They're rowing upstream at the rate of 1 mile an hour, and the current of inflation is coming down at 3 or 4. They're going backwards. So this is a huge mistake when people put that in. Sometimes I've had people sort of be embarrassed. They say, well, I was thinking about taking a trip with $500,000. Where are you going? To the moon? You should only have enough in the bank or the credit union for an emergency. Now, the next big reason people miss out on fortunes is because they are putting their money into what I call or crawl investments. I used to have a diagram of what I called the $1 million dash. And so let's say the goal is to get around the racetrack and the finish line is $1 million net. $1 million after tax, everything, $1 million for your retirement, because in my books I talk about how $1 million can generate $70,000 to $100,000 a year of tax-free income into perpetuity. You need to learn how to do that. But see, first of all, let's get the $1 million. Well, if you put money into crawl investments, this would be rates of return of only 1, 2, or 3% in a bank or a credit union. That's a crawl investment. Huge mistake, and I can't believe how many people put too much money into those low-yielding investments. And I say, why do you do that? Well, because a bank is insured by FDIC. Well, correct. But do you know what banks do with your money? Yeah, back in 2007, 2008, 400 banks went under. 900 more were on the brink. They're on the watch list is what it's called. Do you know what happened? They asked the 5 major banks in America, where do you have your tier 1 assets? That's the money they have to have on hand, liquid and safe, in case you need to run to the bank if there's a run on the bank for money. Do you know where they put it? Into the multi-trillion-dollar life insurance companies. They put 30 to 40% of their assets there, and they are borrowing our money. They only pay us 1% interest when we put our money in the bank, and they earn at least 5%. How much more is 5 than 1? So one of the keys is don't use a crawl investment for long-range goals, which sort of connects into the first one. The next bullet point to that sort of relates to the same metaphor, and that's putting money into walk investments. You don't want to crawl. Well, why are you walking around a racetrack? What would that be? Putting after-tax money into a tax-deferred account like an annuity, and then when you take it out, you have to pay tax. You only have one advantage, it's tax-deferred, but you're funding it with after-tax dollars. As soon as you take the money out, you're taxed what is called LIFO. The last interest you're earning is the first money coming out, unless you start to deplete the principal. That's called a walk investment. Let's go to the jogging investments. It's not sprinting. If you want to sprint towards financial independence, that finish line, I'll share at the end what that is. But let's talk about the two kinds of jogging. So I would say a traditional IRA or 401k would be like jogging around that racetrack with the wind at the back at the beginning of the race. In other words, you're getting a tax break on the seed money you're putting into your investment. But when you come around to the finish line, the second half of the track, now you got the wind against you because that's retirement. That's the back nine in an 18-hole golf game of life, and now you agree to pay tax. I can prove to you this is a big reason why people outlive their money, because they don't realize the impact of taxes, taking 25 to 33%, sometimes 40% of your nest egg. If you have $1 million, only about 600,000 or 700,000 of that is your money. The rest belongs to the government. If you pull out 90,000 a year, 30,000 goes to the government, only 60,000 goes for you for gas, groceries, prescriptions, golf green fees, and so forth. And then what happens is when people do approach retirement in those types of accounts, there is an RMD. See, most people go, I don't need the money out of my IRAs yet. What should I do? Most CPAs and tax attorneys say, oh, well then keep deferring until you're age 70 and a half. Now that age is age 72, but at those ages, if you don't start accessing what the government says you're supposed to take out, it's called the life expectancy formula. It's called the required minimum distribution. If you don't take your required minimum distribution, that's called an RMD, it's a 50% penalty on top of the tax. They want that money out and taxed before you die so they can tax it again when you do die. Folks, most people think, oh, well, then let's avoid it by putting it off. You're not saving anything. You're compounding the problem. That's why in my books and my various educational training, I teach people to do a strategic rollout. So don't make the mistake of thinking that you can keep putting that off, especially later in life when taxes are so high. And I'm going to go through and share the last reason why people don't make it to the end and highlight these 6 mistakes so you don't make them. Now, the 6th mistake, there's several, but I chose the top 6, is that many times retirees are really hurting financially and they're not utilizing one of their greatest assets. What is it? It's usually their home. I see many people with homes, especially in the San Francisco Bay Area, and it's a little two-bedroom home, and it's worth $1.3 million. I see other people with 5-bedroom homes in Palo Alto, and it's worth $4.8 million. I said, well, do you want to stay in the home? Well, I don't know what to do. I said, you're sitting on this huge asset. The couple with a 5-bedroom home in Palo Alto, they sold that house. We were able to save them a lot of money on capital gain tax by doing some 1031 exchanges, but they turned around and built a home twice that big in a retirement community in Utah for $600,000. They're getting over $200,000 a year of tax-free income off of lazy idle equity that used to sit in their house in California. Or many times we've advised people, you know what, have you considered a reverse mortgage? This is where you can utilize that money or get an income the rest of your life, and you don't have to make a mortgage payment anymore. But when you die, the mortgage can be paid off with your death benefit, or your heirs can sell it. And it's sometimes a good solution and strategy, but people sometimes are scared of a reverse mortgage. So going down the list, let's make sure you understand these 6 mistakes. People using short-term investments for long-range goals or long-term investments for short-range goals. Don't do that. Putting money in crawl investments like CDs and bank accounts, or maybe putting money in walk investments, after-tax money into a tax-deferred annuity. That's not going to get you around that racetrack. Oftentimes thinking that IRAs and 401ks are the best way to jog around that racetrack, well, you're going to have to pay tax at the end. If it's a traditional, on a Roth, you're paying tax on the front end. There's something far better. I'd rather sprint around that racetrack, and that's by using what I call the laser fund. And I want you to watch this episode next so that you can see how you can get a free copy of my most recent book called The Laser Fund, because it knocks the socks off of any of these and you sprint around that racetrack. Then the last is understanding that you don't take RMDs, required minimum distributions. That's actually mistake number 5. And the 6th is not using maybe your house or your real estate to turn it into a tax-advantaged income. So those are 6 mistakes you can avoid. And if you don't know how to do that, or you're wondering, golly, this is resonating, but I want you to watch this episode and then take advantage of getting a free copy of my most recent book, The Laser Fund. You just cover shipping and handling, and I'll fire one out to you.